Hey everybody, back with another dividend analysis, and today we're going to be looking at the JM Smucker Company, or simply Smuckers, ticker SJM. Going to be looking at Smuckers because their ticker's been a bit beaten up over the last few months, so maybe we can find a safer yield at a bit of a discount here. Starting with the yield, we see that it's currently at about 3.3%. Not too bad there, doing about twice what the wide market is doing if you were, say, invested in the S&P 500. So, again, not too bad, not amazing, but an okay yield. Going down and looking at the history, we can see that if we went back to 2013, we'd be getting about 58 cents a share, while currently we'd be getting 99 cents a share with the most current raise. Some pretty good growth here, good jumps, anywhere from 6 cents to 3 cents, 8 cents, up to the current one, 9 cents, which is the largest jump we've had in those last 8 years. So definitely some growth here. That dividend is appreciating, not too bad. I can also tell you that if they were to pay their current dividend of 99 cents for the next 3 quarters, their full year dividends paid out would be about $429 million. Let's see if they can afford to support that. Starting with the free cash flow, we can see their most current free cash flow was $1.26 billion, and doing our ratio, that comes out to about 36% of free cash flow being paid out in dividends. A very nice number. Right around a third of their cash flow goes to shareholders in the form of dividends. That is well under our ideal range of 50%. So even if that free cash flow was to drop by a significant amount, they would still be able to cover that dividend. Looking at the cash flow history, we can see it is generally an upward trend, going from 860 to 900 million, a little drop here back down to 780 million in 2019, but then in 2020 rebounding up to nearly $1 billion, and again up to about $1.25 billion. Looking at this, you pretty much want to see why did they jump back up so much in this time when we had a large shutdown of the economy? Is this number sustainable? Is this $1 billion to $1.25 billion sustainable, or are they going to drop back down to maybe 900, maybe this 980-ish million number? Keep that in mind looking forward at the next few quarters, looking at the next couple of years. You want to see if that cash flow trend is going to continue. If so, then that dividend is going to be very safe. If they're going to be able to keep these, making an extra $100 million a year, probably not that much, but if they're able to increase this cash flow by a few $1,000,000 a year, that dividend looks pretty safe. Heading over to the income statement and looking at their profits, we can see that last year they did about $872 million, and that gives us a ratio of income of just under 50% at 49%. So pretty good there, meaning that if their income fell in half, they would still just barely be able to pay that dividend. Now, it is of note that their income did take a huge drop from 2018 down to 2019, falling more than in half, but has started to rebound since then. This is a little uneven. I'd go into this, see, are there write-offs, was their actual profit down, or were there things that were happening in their numbers? Were they doing some financial gymnastics to get that income down? You want to look at those kind of things. If they solidify around this $700 to $800 million mark and just increase that a few percent a year, going up a few $1,000,000, then again that dividend looks relatively safe. If they keep going with these 8 or 9 cent dividend increases, maybe not so much. But if we look back and we see these these 6 to 7, maybe that size dividend increase, if we follow what we've been doing here, going from 600 million to almost 900 million over 5 years, those raises are going to be very safe. That dividend is going to be very well supported. So how is Smucker making this money? What do they do? I would assume most people know, but they're obviously most famous for, grape jelly, among other preserves. But they have essentially 4 different sectors. They do coffee, if you know Folgers, that is Smucker, among other coffee brands. They do their food segment, which is, of course, most famous for things like jelly, peanut butter, preserves, things like that, as well as some other foodstuffs. They do pet food, and then they have an overseas segment. So this is definitely a consumer staple. These are things that are going to be bought regardless of how the economy is doing. They might not be bought in as high of numbers, but this is definitely something I would consider to be recession-proof-ish. People are always going to be buying these kind of foods. They're going to be buying pet food. They're going to be buying coffee. If the economy does take, the downward turn, a peanut butter and jelly sandwich might become dinner for a lot of people. So keep that in mind if you're looking at this, the safety of the company, stuff like that. If you're going to analyze this, if there are numbers you want to follow when looking at this, you'd want to look at consumer sentiment. You'd want to look at production, see if they're able to keep all that food being produced, stuff like that. Those are metrics that you want to research if you're looking at this company. So who should be looking at this, and should you be buying it? From a depreciation side, there's definitely a lot of appreciation here. The dividend has gone up more than 30%, more than 40%. Ish about in the last 8 years, so that's not bad at all. There's definitely a lot of room for appreciation, and going back to those ratios of 34% of free cash flow and 49% of income, there's definitely room for that dividend to grow as long as that cash flow and that income stays at this level or increases. If that's the case, I would expect dividend increases to come. From the income side, it's not bad. 3% isn't terrible. 3.3% isn't terrible. There are better, consumer staple dividends, higher, I should say, things like Altria and, some grocers are even paying a higher dividend. But for just a food producer, this isn't terrible, especially for a large cap one. It's up there. There are a lot of other, consumer staple food stuff producers, things like Coke, Pepsi, other places where their dividend yields are under 2%. So this is definitely higher than that. If you were looking to, organize a consumer staples part of your portfolio, this might have a place in it. Again, it might be if you're looking for one of those really higher yields that isn't super safe. This is a lot safer. The yield's a bit lower, but it might be able to balance out your portfolio in that way. The one thing I would say is that currently the stock might be a little overpriced, just considering, what the company is. It's a very large company. You're not going to get a ton of growth. So a PE of about 17 might be a little high. If I was looking at this, I'd really like to get in around that $100 number. This currently overpriced market is a little rough to deal with, but if I could get this around $100, I'd probably be happy. If there's any kind of downturn in the market and this drops, I don't see them going out of business outside of poor management. It's really hard when you're a consumer staple company like this with selling things that people need to really go out of business unless you're making really poor choices as management if the company's being mismanaged. Another thing to look at is their debt. While their long-term debt isn't really an issue, as we'll see here, having, going to the balance sheet, their total current assets are just under $2 billion, while their total current liabilities are almost $3 billion. That is being quite underwater. However, their total liabilities are well under their total assets. So just be sure that when you're looking at this, they're able to pay that debt down. They do seem to operate at a deficit as a rule of thumb for the most part. 3 out of 5 years they're operating at a deficit. So just keep watching the balance sheet. Make sure that this debt doesn't get out of hand. That could be one way you could get burned on something like this, is if those total current assets fall so far below their liabilities that they start having to sell things off to pay off those debts. That could doing such a thing over a long period of time could see the company start to falter. That is where mismanagement would come in. But if you're looking at this, if you're one of those people who's like, I'm just going to buy, a share a month and just hold it for 40 years, then, go ahead. You'll dollar cost average in over the long term. If you're someone who's looking to put together, an appreciation portfolio or an income portfolio, and you want to buy a large amount of something like this, I would tend to wait for this to either calm down or for the market to calm down, because just a 17 PE for such a mature, for a large company like this, you're really not, that's just, you're paying for growth that's already occurred. I would really wait to try and get down around that $100 mark if you can. If not, if you want to go into this, it's definitely not a bad company. I don't see them going out of business anytime soon. I don't see, the stock falling in half outside of a market crash. So yeah, if you like it, it's definitely not a bad choice. There are better choices out there, of course, in consumer staples, but this one isn't terrible. So yeah, I hope this helps, and thanks for watching.